Welcome back to Stock Spotlight. I'm your host, Michael. Today, I'm reconnecting with Shivam from Night Vision Capital to revisit MercadoLibre, one of the highest quality and most widely discussed growth companies in public markets. Because MELI already receives so much attention, this is not going to be a basic overview of the business. We are assuming listeners have a working understanding of MercadoLibre's commerce, logistics, Mercado Pago, and credit ecosystems. I want to focus on the questions where I think genuine disagreement remains. Is the stock actually expensive once we separate reported cash flow from fintech funding flows? Is the rapidly growing credit book a durable extension of their data advantage or a form of hidden leverage? Are lower margins evidence of weakening economics and increased competition, or the result of rational investments that make the ecosystem harder to compete with? And should investors value MELI as one integrated platform or several businesses that require very different valuation methods? Shivam recently traveled to Brazil and presented MELI as an investment idea in front of professional investors. So this felt like the right time to reconnect and to test the thesis from both an operating and valuation point of view. To kick things off, Shivam, why don't you tell us about the Brazil trip and the opportunity to pitch MELI as an investment?
First and foremost, the Brazil trip was excellent. It was interesting to see this economy firsthand, as it's a country where many people told me they'd love to visit. The people were friendly, the food was great, and the scenery was awesome too. The presentation went well. The room was primarily composed of portfolio managers from various parts of the world, some of whom were very familiar with Meli. Some owned it, some previously owned it. After the presentation, many approached me and stated they were going to do more research into the business as well. So that was good to know.
What did you learn about the company by being in Brazil that you did not fully appreciate? I actually haven't had the chance myself to get down there, and it's something that I've wanted to do. Tell our listeners a little bit about just being in Brazil too.
To be clear with you, Mike, I was in Brazil for a conference and I spent some time exploring Rio, but I didn't visit any of Meli's operations. However, one thing that did stand out was the company's brand awareness. I spoke with multiple people while I was on my flight into Rio, and everyone that I asked knew Meli and they spoke very highly of it. That's a very small anecdotal situation, but it did give me the impression that the company is well known and trusted, and I know that trust is a very powerful mode, especially in Latin America. What was interesting was that I didn't see Meli logos or trucks anywhere while I was in Rio. That reminded me that much of Meli's competitive advantage comes from behind the scenes with its fulfillment centers, the delivery network, and the fintech arm, and it may not be visible to a casual visitor like myself. It's also difficult to draw conclusions about Meli just from visiting one city. Rio may not be comparable to Sao Paulo, for example, or other areas. I wouldn't say the trip changed my thoughts exactly on the company, but it did show me that Meli's presence may not be as visible as I initially thought it would. But that just makes rigorous analysis of the operating data for the business even more important.
That's a great point. I mean, I think you might see their vans and trucks out and about, but a lot of their business is behind the scenes, which is why I thought it was a great opportunity for them to advertise at the World Cup. So one other thing too is you mentioned, when we were chatting that some of the larger fund managers were maybe skeptical because of the credit book and what they viewed maybe as a high valuation. So could you walk us through some of those concerns?
Sure. So most of the skepticism was around their credit book. The concern was poor or lax underwriting criteria, just given the high growth of the credit business. And another piece that attracted some skepticism was their valuation. And we can discuss both in greater detail later in the episode since we will be covering those subjects.
So one thing I found interesting that I wanted to ask you about now, a recent Morgan Stanley chart, I think highlighted on X by CapEx and Chill, who's a great follow as well. It suggests that MELI captured, I think, around 26% of the incremental e-commerce spending in Mexico in 2025, and that was up from 4% in 2017, while Walmart, Mexico, and Amazon captured smaller shares of the year's growth. What do you think that MELI's doing differently in Mexico, and how far can that share gain story go?
First of all, CapEx and Chill has excellent content. I'm always impressed with his research, especially with regard to MELI. With Mexico, MELI is gaining share because it's doing more than just offering online shopping. They provide an entire ecosystem comprised of the marketplace, delivery, fintech, and buyer and seller financing. The fintech side is especially important in Mexico since only about half the population has a bank account and less than 20% of Mexicans have a credit card. As far as share gains, I believe there's a meaningful opportunity for MELI to gain share in Mexico. E-commerce in general is still growing and they can take share from offline retailers and competitors too. It's important to keep in mind that Amazon, Walmart, and some Asian companies are powerful competitors too, however. This doesn't need to be a winner takes all market, though. It's not about MELI dominating the entire Mexican market. They just have to continue to maintain a higher share of the rapidly growing market over time.
And then also Mercado Pago has become one of the most widely used digital financial platforms in Mexico. And I think you called this out on X as well, but its application for a full banking license is an important strategic catalyst there. So if that license is approved, what really changes economically that MELI can't do today?
So MELI is already the second most used app in Mexico currently. If the banking license gets approved, then I believe growth will accelerate. I recall MELI previously stated they want users to be able to directly collect their salaries in Mercado Pago. So if they were to get the banking license, they would obtain something called IPAB, which is basically deposit insurance for Mexican banks. This would further strengthen their ecosystem by creating trust, or rather increasing trust, and allow MELI to be the primary financial account for users. They would have more data for their lending business because they could access income data and savings habits in addition to purchasing data, among other things. So once MELI's users have all their funds in the ecosystem, the system itself gets stickier because customers who are already purchasing products from MELI won't have to worry about transferring funds into the ecosystem, among other things. It would just be a lot more efficient for them. And then on top of that, once MELI feels comfortable with their underwriting, they would have access to an even cheaper source of capital to grow their lending book.
It is going to be fascinating to follow because it gives them that powerful growth lever. But the trade off is that faster credit growth also increases underwriting and that balance sheet risk. So, with that in mind, let's turn our attention now to Argentina and historically one of their strongest competitive positions. But macro volatility has often made the reported results difficult to interpret. So, what do you think's going on there right now that investors should know about?
Argentina's performing well, but it is probably the most difficult market to analyze inside of MELI. In the most recent quarter, for example, their GMV grew the most, but that's not all. Their net revenue increased 65% in local currency, but only 23% in US dollar terms. Inflation was above 30%, so the local currency growth overstates the real growth. Its direct contribution margin also fell from 47% to 36% year over year. This is still attractive and greater than both Mexico and Brazil, but it could drop further as MELI is continuing to reinvest in logistics and credit. So I look at Argentina as a source of opportunity and volatility at the same time. If inflation continues to fall, MELI could benefit from recovering purchasing power and increased credit demand, among other things. However, I would not expect the high growth rates from the initial recovery.
Yeah, and I love that for listeners, the opportunity, but also volatility there. One other geography that I want to touch base on is China. One interpretation of MELI's strategy is that it can use local payments and logistics and fulfillment and merchant infrastructure to really intermediate Chinese supply rather than merely defend against it. So, how do you think about their cross border or full China strategy?
Shipping from China to Latin America has historically been slow and difficult. Packages would end up getting stuck in customs for weeks. So, to solve for this issue, what MELI did was they built a fulfillment center in China so they can take over the entire logistics operation for Chinese merchants. So, if you have a country like Brazil, for example, with complex import regulations, MELI adds value because it already has the local logistics and compliance expertise, and That expertise exists throughout various parts of Latin America. The full China strategy strengthens MELI's flywheel by adding more sellers, which then add more inventory, and then that attracts more customers.
Let's now turn our attention to credit, because this is where I think the investment case gets the hardest, but also maybe most interesting. The portfolio has expanded rapidly. So I think the credit segment is now 21% of total revenue as of trailing 12 month Q1 26, which is up from 11% in 2021. And the same data advantage that could deepen the moat really can also create meaningful underwriting and funding risk if the models are wrong. So, how do you frame this opportunity without minimizing that balance sheet risk?
I look at credit as both a big opportunity and probably also the largest risk for MELI. The opportunity is that MELI can access data that many other lenders can't. They can look at payment history, marketplace activity, and other behavior across their platform. That should allow them to extend credit to consumers and merchants. And remember, many merchants obtain their first line of credit from MELI, so there's a relationship already established there. Overall, credit strengthens the ecosystem since it can increase engagement with the platform. However, underwriting mistakes can take time to appear because revenue is recognized before the losses from a loan are known. So, as the portfolio grows, MELI becomes more exposed to this risk. That's why I focus less on loan growth and more on NIMAL, NPLs, and loan provisions.
All right. And then you and I also previously discussed the possibility here that Melly can know more about a customer than a traditional lender, and perhaps even more than Amazon, as it can, observe what someone buys, what a merchant sells, payment flows, customer borrowing behavior, and repayment history. So, do you think that's a durable underwriting advantage, or does it risk creating, false confidence during different credit cycles?
This one's a bit nuanced. I believe MELI's data does give them a durable underwriting advantage, but it's not a guarantee, of course. A traditional lender would mainly see income, a credit score, and then repayment history. MELI, on the other hand, as you said, they can see sales, purchase history, payment flows, and how customers generally interact with the platform. However, more data can also create false confidence. For example, a model developed during a good economy may underestimate how borrowers behave during a downturn. That said, I view data as an advantage, but it does come with its own risks.
No, yeah, that makes a lot of sense. And in my experience, building different models, the simpler model, the better, usually wins.
Absolutely.
Okay, so you kind of mentioned NIMAL and a few others. I wanted to ask you if you had two or three credit metrics that investors should track, what would they be? You might have mentioned a few, but just wanted to make sure that we have that for listeners as well.
So I think investors should track NPLs, NIMAL, and loan loss provisions. NPLs show how much of the loan portfolio is behind on payments. I would track not only the level, but also how it evolves as the loan book grows. In Q1, their NPL ratio was 8%, for example, and this was stable year over year despite their loan book growing over 80%. NIMAL shows the return that MELI earns on those loans after losses and funding costs. NIMAL declined to 17.8% year over year, but a meaningful amount of that was due to a higher mix of credit cards. However, a continuous decline of that could suggest that MELI is taking on more risk without getting an adequate return. And then loan loss provisions should be tracked relative to the total loan book itself. They could provide an earlier warning than NPLs and NIMAL, since MELI is predicting what their expected losses would be. This is important because MELI is currently experimenting with longer duration loans in Brazil. These loans may expand their TAM, but they also increase the risk nonetheless. And no single quarter would concern me with the business, but this is something I would monitor over the long term.
Yeah, no, that's fantastic. And I agree. You definitely want to monitor over multiple quarters. I think it's pretty clear, at least if you're on X, reading some of the comments about Melly, they're definitely back, in a heavy and also management as well. They're back in more of a heavy investment cycle. So, lower free shipping thresholds, credit card expansion, expanding logistics, and all of that can depress near-term margins, but strengthen the ecosystem as well. So, how do you distinguish between what I'll call productive margin compression, from a company that's simply spending more to sustain growth.
The key thing I'm looking for here is whether they're building and improving the business or simply filling a hole. So I would view the margin compression as productive if MAUs and purchase frequency are growing, unit shipping costs are falling, and credit returns are attractive. However, I would be concerned if GMV and users were growing while purchase frequency and credit returns were falling. Since they've lowered the free shipping threshold in Brazil, GMV and items sold have accelerated while shipping cost reductions have accelerated as well. Unique active buyer growth accelerated, and same and next day shipping growth also accelerated, so it appears to be working thus far. What's important here is that MELI utilizes their slow shipping network for a lot of items. Basically, what they do is they put these items on leftover space in their trucks, which brings unit shipping costs down. Management expects these shipping costs to continue going down as they add more capacity, so this is a trend that needs to be monitored. However, what investors need to keep in mind is that this trend is not going to be linear.
One thing, transitioning a little bit to their cash flow and valuation, one thing that kind of originally spurred this conversation was Meli's valuation framework. A lot of investors new to Meli take reported operating cash flow or free cash flow at face value. But customer funds, card settlement balances, loan originations, receivable growth, and credit loss provisions can make reported cash flow difficult to interpret. Good news, though, is that Melly now reports this adjusted free cash flow measure to remove restricted customer funds and lending related movements. I've also seen an analyst revise free cash flow framework on X and wanted to ask you, how do you handle their underlying economic cash flow? And do you prefer beginning with operating cash flow and then normalizing the fintech working capital items, or beginning with EBIT or operating income and then building towards cash flow from the operating business?
MELI breaks down adjusted free cash flow for investors in their earnings presentations, as you said, so it becomes pretty straightforward just using that method. What I do is I add back in the loan receivables line and then I subtract out the fintech funding line. The loan receivables, of course, are funds that they lent out to grow their loan book, and fintech funding is just debt they issued to grow this segment as well. The adjustment allows me to figure out roughly what the true earnings power of the business would be if they stopped growing. Investors will see that money come back with a return later on, so it makes sense to capture that value. For example, Amazon's free cash flow is negative, yet the business is worth trillions of dollars. Now, I personally believe that is because of what they are able to generate if they stopped reinvesting.
And then turning to CapEx, so their CapEx includes both maintenance spending and growth investments in logistics and technology. One thing I've done with my portfolio now is I look at all my companies and kind of define where I think they are of a percentage of total capex of maintenance and growth. How do you think about both current and then we'll call it long term normalized maintenance capex for a business like Melly?
There isn't a way to know what portion of CapEx truly is maintenance versus growth, so my assumption is a conservative estimate. Maintenance CapEx as a percentage of the total is likely less, given that much of their growth is coming from the asset light fintech side. But I would rather err on the conservative side and show that even if we over allocate to it, the business still remains attractive. And I'll be happy to mention more about it when we discuss Melly's valuation.
That's great. And I think I'll have to pull up, but I think of my own portfolio spreadsheet, I've got maintenance between 15 and 30% or so, and definitely can change over time. So that, we've now got a good handle on, we'll call it normalized cash flow and CapEx assumptions. Then we turn our attention to valuation. And another thing I've learned just researching Melly is that very thoughtful investors can reach different conclusions, because they're really valuing the business in a different way. And Melly is kind of an interesting business where, it is interesting to think about maybe a sum of all the different segments, some of the parts kind of valuation model. So I'll just list off two that we can react to from X, who've done some pretty interesting valuation models on Melly and then their intrinsic value. So Wolf of Harcourt Street, he uses a consolidated DCF built from normalized operating cash flow, which is kind of what we talked about here. And he arrives at around a $2,646 per share value versus I think he had a reference price of 1843, which implied around 44% upside. And then also Hated Moats, who also does great work on Substack and X, he uses a sum of the parts framework, valuing for commerce, payments, and credit, and arrives at roughly 1980 a share versus an 1807 reference price. Which is about 9 to 10% upside. So, one to see, where do you kind of land philosophically with valuing MELI?
I'm always open to seeing how other people value MELI. I personally like to keep things simple. So, as I said earlier, I value MELI using a growth rate on their adjusted economic free cash flow with an ending multiple. So, to break it down, trailing 12 month, I calculated about $6.9 billion in economic free cash flow, which is roughly $137 per share. I'm assuming a growth rate of 15% over the next 5 years, which I believe is conservative given the runway and the opportunities that MELI has. And then I use an exit multiple of 13 times. And with these assumptions, I can potentially get a 15% annualized return over the next 5 years, assuming an $1,800 share price.
I love that too, because that 15, that kind of hits my hurdle rate with investments. And I think we were mentioning before we aired, but my last buy was at 1600, and I might be looking at some more buys in the future because a lot of our models still have them as either undervalued or at least if nothing else closer to fair value. And then I also think MELI is just one of the more fun companies to try to value, and maybe I'll do a post on it, but. Working on my own kind of sum of the parts, and there's a few other businesses like this, like Toast, and different other kind of companies like that that have roll ups, are kind of interesting to value with this approach. In your model, kind of what's the most important assumption that's driving that fair value?
Long term e commerce and fintech growth are driving my assumptions basically. E commerce still has a long runway since over 80% of Latin America is still untapped, and cash transactions are still a pretty large part of the economy as well.
Now, I want to end the discussion kind of where we started with expectations. And part of our discussion around MELI has not necessarily that MELI deserves this enormous multiple, but that once you account for reinvestment, fintech funding, and just general economic cash generation, the market may be embedding more modest expectations than the headline multiple suggests. What does an investor buying MELI today actually have to believe, you think, for the investment to work?
I don't think an investor has to believe MELI will continue growing 30% or more forever, or even rely on a high multiple. But they do have to believe MELI can compound their earnings and free cash flow at least a mid teens rate or higher for many years. Now, for that to occur, investors have to believe e commerce and MELI's market share will continue growing across Latin America. MELI's investments in shipping and logistics will eventually produce operating leverage, and their credit business will continue generating attractive returns.
And then conversely, what assumption do you think the market is making today that is most likely to be wrong?
I think the market assumption most likely to be wrong is that MELI's current level of profitability is an accurate representation of its long term earnings power. MELI is currently heavily investing in free shipping, logistics, and fintech right now. Those investments artificially depress current margins and free cash flow, which makes the valuation appear more expensive than it actually is. The famous investor Nick Sleep made a similar point about Amazon in its reinvestment phase. He stated that valuing Amazon solely on their reported free cash flow basically assumed their growth spending had no value at all. I think a similar situation may be occurring with MELI right now, and the market may be focusing too much on present spending versus the future earnings those investments could generate.
Yeah, I love that. That's a great quote there. So let's finish with a quick lightning round of rapid fire questions. These will be short answers, and then I might ask one follow up if something stands out. First question: what is one thing you have changed your mind about with MELI over the last year?
That MELI is just the Amazon of Latin America. That was my first impression when I began studying the business, and then I realized it wasn't an accurate description for the company at all. They're actually a combination of Amazon and Alipay. MercadoLibre provides the marketplace ecosystem, while Mercado Pago provides the fintech ecosystem. So they're not necessarily comparable to Amazon.
I love that. And same with me. So, second question, 5 years from now, which business do you think investors today will realize they most underestimated? Advertising, commerce, payments, credit, or something else?
I think advertising is a business most investors underestimate. My friend Dimitri Nakla has a good write up on X about this, and I recommend everyone reads it. Traditional channels still account for half the ad market in Latin America versus just a quarter in the United States. So there's a long growth runway here. And as more ads migrate online, MELI should capture a large share of that just due to their user base, their first party transaction data, and the ability to connect the ad spend directly to sales.
And then, what single development over the next 12 to 24 months would most seriously damage your investment thesis?
A deterioration of the credit business would be quite damaging. If the credit portfolio continued growing, but NPLs rose enough to materially reduce NIMAL, then I would be concerned that MELI was using credit to manufacture growth in its commerce and fintech segments. I wouldn't change my thesis because of a couple weak quarters, because MELI is rapidly expanding this credit business, and this is a very underpenetrated segment as well.
All right, GMV and TPV are the two obvious KPIs to track with Melly. Give me a third.
Fintech monthly active users also deserve some attention here. GMV and TPV tell us how much value is moving throughout the ecosystem, but they can be influenced by things such as inflation and currency, so we have to keep that in mind. However, fintech MAUs tell us if the user base is expanding or contracting. In the last quarter, MAUs increased 30%, while total payment transactions increased 39%. Since transactions are growing faster than MAUs, it suggests people were using Mercado Pago more often.
And then last question, Melly has a new CEO at the start of 2026. I'm not going to try to pronounce his name because I'll probably say it wrong. The founder did move to executive chairman. What should investors be watching to determine whether the succession preserves their that founder-like culture and capital allocation discipline?
What I found interesting was that Ariel, the commerce president, was chosen to be CEO over the more experienced fintech president, Osvaldo Jimenez. Now, Ariel was handpicked by Marcos Galperin and was taken under his wing several years ago to train for this role. This hints that Meli's core business is still going to be commerce. So investors should be monitoring commerce growth, especially at the business, along with their long term oriented culture. The CEO and CFO have consistently emphasized they're willing to sacrifice short term margins for long term value creation. This has been true of Melly since the beginning, and a shift in that dynamic would pose a risk for investors. Another key thing for investors to monitor is the culture of innovation. The co founder, Stelio Tolda, said that Melly is always in beta mode and they are always focused on improving. They work very hard to preserve this culture, even in their job interviews, so a change in this mindset also poses a risk.
Yeah, thanks, Shivam. And it's been great having you on. We appreciate your insight on Melly and look forward to having you on again soon.
Absolutely. Thanks for having me, Mike.
And that's a wrap on today's Stock Spotlight conversation with Shivam on Mercado Libre. Preparing for this episode changed how I think about both the quality of the business and the difficulty of valuing it. Melly combines commerce, logistics, payments, and credit in a way that strengthens the ecosystem, but also makes consolidated financial statements much harder to interpret than the headline numbers suggest. I ended up building a sum of the parts framework because I could not find one valuation method that felt equally appropriate for every segment. Whether that is a right answer or whether I'm overcomplicating a business that should be viewed as one integrated platform is exactly the kind of tension I wanted this episode to explore. If you found the discussion useful, subscribe to the podcast, leave a rating or comment, and vote in the episode poll. I would especially like to know whether you value Melly with a consolidated DCF, a sum of the parts framework, or a simpler multiples or yields based approach. Thanks again to Shivam for joining me, and sharing what he learned in Brazil and from testing the thesis in front of other investors. Until our next episode, keep your process sharp, your standards high, and your portfolio intentional.